Welcome to Inside Scoop with Sean Emery. Every week we are examining something new, bringing you closer to companies, sectors, and themes. This recording should not be construed as a substitute for personalized individual advice from Avery & Company or any guest on the show. This is for educational purposes only and not intended to make an offer or solicitation for any companies or securities mentioned. With that, let's get on with the episode. All right, hello. This is another episode of Inside Scoop, our fourth episode with a leading company around transportation, logistics, warehousing. We had the CTO of Flex at one point on one of our episodes talking about flexible warehouse space. We had the rideshareguy.com talking about shared mobility, Tortoise talking about robotic delivery solutions, and today we have Freightos, one of the leading companies in logistics providing software as a service to different carriers around the globe. They will talk more about their business, the trends they're seeing, how freight rates are moving over the last 30, 40, 50 days. We've seen freight rates come down materially. This is a good thing as it relates to things like inflation and what the future holds for the future of freight. We thought this was an incredible episode, so let's get straight to it. All right, today we have an exceptional guest in, Judah Levine, the head of research at Freightos. Judah, welcome to the show today.
Thanks for having me.
Yeah, so tell us a little bit about Freightos and a little bit about yourself.
Sure. So my background is in market research, and I'm a head of research at Freightos Group. Freightos is a logistics technology company, and we are kind of pursuing a vision for end-to-end digital freight. A lot of logistics, a lot of the freight industry operates offline, and up until a few years ago, there were no options to connect the different supply chain stakeholders online. That's something we're trying to solve for. So we have a few different units that try and do that. So we have the Freightos.com marketplace, which connects small business importers and exporters, or thousands of these SMB importers and exporters, with dozens of freight forwarders, which are kind of freight brokers. They go between the ocean and air carriers and importer exporters. And then we also have the web cargo business unit, which connects ocean and air carriers with freight forwarders to facilitate, sharing of all kinds of different information, including e-booking, which has been, has seen a lot of growth over the last couple of years. In addition to all those kind of connections and sharing of data, we also have a vantage point to some of the data going on in the industry. And so we also have a Freightos data business unit. And within that, we have the Freightos Baltic Index, which is an index for ocean freight, a spot rate index to ship 40-foot containers across different lanes. And one of the things I do is produce a weekly update, which is kind of based on what's going on in the Freightos Baltic Index, FBX. And I'm going to be referring to that a bit as we go through.
Yeah, I'm definitely a follower of that. So I know you have an operation here in Miami. I know kind of the team in general located where? Israel, around the world. Obviously, you're global in nature. So tell us a little bit about the team and how you guys are structured slightly.
Yeah, so we have a big team in Jerusalem, as well as an office in Ramallah. We have offices as well in India and in Asia, and we have a very large office in Barcelona, where the web cargo business unit is located.
Got it. And it's kind of slightly off topic, but what do you think is driving? I hear Israel, right? And over the last, I'd say, decade, there's been a lot of talent and entrepreneurship that's come out of Israel in general. Checkpoint, Teva, Fiverr, Wix, Nice, all different industries. It's a little bit a deviation from logistics, but what do you think is some of the drivers there? What do you think's happened over the last decade that's really unlocked entrepreneurship and kind of these exceptional skills that many of you have?
Yeah, that's a really good question. There's a lot of several books written about it, so I wouldn't want to speculate. But from my perspective, there's a shortage of natural resources. Up until a few years, there was a natural gas discovery, and I think that's really part of the Israeli mentality, is kind of hustling and looking for opportunities, and the desire to really be players on the world stage, even though we're a very small country. So I think there's a lot of that drive. And there's also, of course, there's a lot of talent and technology development within the IDF, within the military, and a lot of that tech talent, starts early in terms of the mandatory military service and comes out looking for opportunities.
Interesting.
So yeah, but I'm no expert.
Right. No, it's just a product of, I guess, whatever the foundation is. But there's a lot of talent there, just to point it out. But let's get to the main topic here: is trends you're witnessing today and over kind of several months. Maybe it's the last several months versus a year ago. Kind of what are you seeing in the data that you guys have?
Right. So if we talk about ocean freight, really we'd have to start about 2 years ago when there was this big shift. So in June of 2020, when it was clear that kind of the pandemic was here to stay for a while, we had this big shift in spending, a big shift and increase in spending on goods, especially if we talk about the United States, away from services and towards goods. And 90% of the world's goods travel by ocean. So this big increase in demand started being reflected in climbing ocean rates already 2 years ago. For frame of reference, to ship a container from Asia to the U.S. West Coast Before the pandemic, typically costed around $1,500, plus minus a little more in more peak season. But by the end of 2020, it was up to $4,000. And then last summer, so each summer is the peak season in ocean freight. So every year on the Trans-Pacific, starting in around this time of year, July, August, with a big increase in demand as all the stuff that's going to come in for back to school and for Thanksgiving and then into the holiday season, all that stuff has to be brought over starting then. So we usually have a big increase, an increase in demand, an increase in volumes, and an increase in freight rates. Last year, as rates were already rising and there was already this increase of demand, we saw a tremendous spike. So from May to September, rates went from $7,000 per container up to $20,000 per container, which was an all-time high. And again, this was due to this increase in demand and the growing congestion. So as things got more congested, even if ocean carriers were throwing more ships at the problem, you couldn't really increase the capacity that the ports have to kind of process all those containers, and that just kind of restrained that capacity and pushed rates up. After peak season last year, we also saw the seasonality of rates coming down. They fell from 20,000 to 15,000. The 15,000 is still 10 times the normal, still extremely elevated, as we had, again, this increase in demand. We had a continuing problem with congestion. To get to your question, over the last couple of months, we've seen a big decline in rates. So we had that kind of $15,000 per container level. And then from the end of March until now, there's been, from Asia to the US West Coast, more than 50% decline. So rates are now about $7,300 per container. And that big drop started in May and continued through June, although we've seen some leveling off in July. And at first, the theory was that this was during the Shanghai lockdown. Shanghai was locked down from about the beginning of April till the beginning of June. And one of the theories was that as Shanghai was locked down, all this manufacturing is shut down. It was very difficult to get to the ports because of trucking restrictions and things like that. And one of the theories was that there is underlying demand. It's just you can't get exports out, so that you couldn't meet that demand, and therefore demand for ocean freight was falling. Shanghai started to reopen in June, and we continued to see rates fall since then. And alongside, kind of during the Shanghai shutdown, we also started having kind of economic indicators that something was changing. So we had, some of the biggest retailers like Walmart and Target announcing an increase or an excess of inventories, whereas since about June 2020, inventories had been way down, or at least inventory to sales ratios. Businesses were bringing in goods, but they couldn't keep them stocked on the shelves. And things were taking much longer to come across because of those, because of the congestion and things like that. So this big increase in inventories was one of the signs that consumers spending is changing. Either because things are starting to open up, now people are able to spend on travel and entertainment, which weren't really as much options last year, or probably both at the same time. But the bigger driver might be rising inflation. As we know, the new inflation numbers just came out. And as people are having to spend more on necessities, they're shifting away from spending on some of these goods that we've been buying over the course of the pandemic. Again, it's not across all types of goods, but the big, some of the big home, big ticket items for homes like furniture and electronics. Those are kind of where the buildup of inventories are. And so that seems to be kind of the main driver of this decline in rates that we've seen over the last couple months. Just one more thing that I wanted to show as an indication. There was a report this week, an analysis of utilization levels, which means how full the container ships are. And over the course of the pandemic, from Asia to the US, it's almost always been above 90%. And when you have ships full 90% and above, that puts a lot of pressure on rates, either pushing them up or keeping them elevated. And so this report, which I think was based on May, but it may have been kind of just last month, shows that they've dipped below 90% for the first time since the first half of 2020, which again is another indication that something's changing. And then finally, the other kind of interesting thing going on in terms of freight rates, as I said, we had this big decline in spot rates, and the spot market is kind of a one-off commitment to ship a container. Bigger shippers or bigger importers, exporters will have contracts with ocean carriers for at a locked-in rate, which is typically below the spot market rate, and they commit a certain volume over over the course of the contract. And now we've seen the spot rate has dipped below the contract rate, which puts a lot of pressure on on the parties involved if you're now kind of paying a premium on a contracted rate. And just in terms of the FBX, the FBX can be used as a basis for index linking. So you can link your contract to this index, so you're kind of you're paying the market price up or down. And in February we launched the CME, Chicago Mercantile Exchange, launched the ability to trade derivatives or future freight futures based on that index, which again, this is kind of early days for these types of options to shippers, but it's something that we see kind of the need for in this types of volatility.
Yeah, so two things there. So one, I think it sounds like the pandemic has unlocked two different, call it changes, innovations. Is one, the adoption of technologies such as yourself And then two, it sounds like, again, a derivatives market that allows potentially on a future basis, a lot of these companies to hedge out some of their inflation costs or shipping costs in the future, right? Is that kind of the best way to think about how the pandemic morphed some of these changes?
Yeah. So, I mean, as you said, the adoption of technology and logistics has been growing over the last 10 years or so at a certain pace. But like it has in a lot of industries, this has kind of accelerated that trend. So again, from our example from web cargo, there was airline e-bookings for freight forwarders before the pandemic. But with all the volatility and people working from home and just kind of the speed of how fast things were changing, we've seen a tremendous increase in kind of adoption of that kind of solution. So that's definitely been part of it. And in terms of financial, other ways to address the kind of the problem financially, as I said, that's we think there's a need in the market, and the fact that now these are available on a recognized exchange is an important step. But I think that's going to see progress as we move forward based on these kind of examples.
Got it. Makes sense. You did allude to, so obviously the fear before was that China's lockdown was a reason behind the drop in price. Asking, there's this fear, right? So it's like, okay, what's the future going to bring for prices as it relates to like inflation, everything that kind of logistics and transportation and freight, how that pushes through the system, and the fear that, hey, we may have the zero COVID policy and that's still in effect. And, 6 months from now, you may have something and that may drive prices higher once again. It sounds like the thesis maybe a couple months ago was that was going to be the case. And that was the rationale behind the drop in price. And then therefore we'd see prices re-rate higher. It sounds like that thesis may not be holding true anymore. And maybe, if you go 6 months from now, one, I think you'll have maybe some of these technologies in place, maybe a little bit more mature derivatives market. Some of those spot prices to contract prices may actually fall back in line. What's like your view of that thesis of like, okay, 6 months from now, a year from now, we may have it again. How well positioned will the ecosystem of kind of freight and transportation be then versus potentially now? I know it's a guess, but how viable is that threat to, an increase in price of what we saw maybe a year ago?
Yeah, well, it's all a guess, as you said, as we know. It's been very complex because there are multiple kind of, you can't point to one driver anymore and say, this is what's going on in global trade in general, or in, freight and freight prices in particular. But certainly, as you said, during the Shanghai, the assumption was there's all this demand, things are shut down, prices are going to drop temporarily, and they're going to get back up. But we seem to have this other, growing trend of this increase in inventories and possibly that falling of consumer demand at the same time. So as you said, it's complicated to say what are we going to see moving forward. If with China's zero COVID policy, if they're shutting down ports and goods can't get out, that's going to impact freight rates. It might push them down temporarily and then push them back up afterwards. But of course, that's dependent on underlying demand. So, it's an interplay of those two factors. Anytime there's some kind of disruption, it's causing problems to the logistics kind of ecosystem. What that's going to do on rates ultimately depends on that underlying demand, which of course is also hard to predict. Just one other thing I would say is that, part of the issue with the Shanghai lockdown and falling rates is that there was also a significant pull forward of peak season demand. So as I said before, normally peak season starts around this time of year, goes up into August, September, and starts to decline October, November. Statistics for import container volumes from the National Retail Federation came out this week or last week, and it showed that May was the new record for monthly imports to the U.S. And so that's kind of early for peak season. But what we know, and we've seen this from surveys we've done of importers, exporters who use Freightos, is that because of what happened last year, because of all these delays, and because sometimes some importers weren't able to get goods in time for the particular shopping season, businesses are starting to pull forward and order those goods earlier. So with all those kind of volumes moved earlier, the fact that freight rates are falling now does show that there's a lessening of demand, right? Normally this time of year, rates start to climb, and we've seen them fall, and now maybe they're evened off a little bit. But it doesn't necessarily mean that importers aren't bringing stuff in for the holiday seasons. It means that they have inventories built now. They may not be expecting as high as they thought they were, and having stuff in the next couple months. Maybe they're canceling those orders. But it's not to say that there's going to be that this necessarily shows there's going to be kind of a plummeting of demand. So for the NRF, for National Retail Federation, their projections for July are just 6% below that record, which is still pretty high, and then kind of a trailing off through October, which shows, there's going to be a decrease in volumes. But the same thing with spot rates. You have to remember, we're starting from a very, very high level. right? So to say that things are going to decline, or to say that spot rates are declining, if we compare them to kind of pre-pandemic norms, it's still extremely high. So for those container volumes, for those months, it's between 13 to 18%, still among about 13 to 18% higher than in 2019 if those projections hold up. And when we talk about freight rates now, $7,300 per container. Normally this time of year they'd be $1,500 or maybe $2,000. So we're definitely seeing something changing. Something is different than what we've seen over the last 2 years. But I think we have to be cautious about how extreme we think these kind of drops are and what they say about the underlying economic.
No, that's interesting because it sounds like you're saying there's record volume still, yet prices are dropping, which just sounds like an easing of the supply of container ships potentially. Is that the case? Is it just simply that now you talked about utilization of these ships falling from where they were before. And yeah, we've heard anecdotally, and we listen to earnings calls and all these conferences. And a year ago, there was a lot of companies that were double ordering ahead of holiday season just to ensure they got it. And then some. You heard like the Walmarts and Targets this year, stuff they ordered maybe a year ago. For outdoor furniture, which less people are buying outdoor furniture relative to a year and a half, 2 years ago. That double order effect, and a lot of that stuff was big items, so taking up space. Just juxtapose the higher volumes versus lower rates, because it sounds like there's a lot of stuff still coming, and it's coming at a lower price relative to last year. And actually, it just simply sounds like we're steadily moving towards where possibly normal rates were. With more people maybe battling on the logistics side for getting that volume potentially.
Yeah, it is. Yeah, it's confusing because there is still demand. I don't think from freight forwarders and from carriers, you don't kind of hear that that there's a plummeting. And again, these projections for the coming months, there's still going to be a lot of pressure on the supply chain and above normal volume. So there's certainly something changing. I think again, it's like starting from that very high starting point. If things are changing and there is excess capacity, so rates are going to fall, but they're still showing that there's a lot of demand. Part of the problem, right? So that's kind of on the demand side in the volumes, which again, it is kind of confusing to say that we're seeing things ease and decreasing consumer demand, but we're still kind of double digits beyond the volumes of things we were pulling in 2-3 years ago.
Right.
So there's kind of these these contrasting indicators, but there are also a couple of things in terms. If we talk about freight rates in particular, like where they're going to go, there are other couple of factors. So the first is the ability of ocean carriers to manage capacity. So if ships are starting to be not fully utilized, they have the ability to manage capacity, what's called blank sailings, or cancel services and just kind of remove some of that excess capacity to meet the level of demand. And that's probably why we've seen a leveling out over the course of July. For Asia, US West Coast, we only saw rates drop about 4%, even though we had that big drop in May and June. And this is something that ocean carriers have done effectively, really for the first time at the beginning of the pandemic. From January till about March, rates remained about level, even though volumes dropped significantly. And that's because the carriers were able to effectively manage capacity and keep rates get capacity at a level to meet demand, get supply to meet demand, which really hadn't been the case a lot of times in the past. And there's a lot of better cooperation in terms of shipping alliances that they're able to share networks so that they can more evenly remove capacity. And that's probably a reason why we're not seeing kind of a continuation of that fall. The other mitigating factor is port congestion. So as I said, when ships are waiting for a spot to berth and they're sitting in San Pedro Bay or wherever they are, they're not circulating. And essentially that capacity is sucked up and removed from the market, and congestion continues to be a problem. So the headlines earlier in the year were out off the coast of LA, where you had 100 ships waiting for a spot, which is crazy. It's come down to to the mid 20s, but normally this time of the year there wouldn't be any, or there'd be one or two. So that's still a significant amount. There's a figure that about 10% of the global fleet is just sitting waiting at any given time right now. So that's still significant, and we've seen the improvements on the West Coast. Some of that congestion has shifted to the East Coast, as importers are looking for alternatives. But ultimately it seems to just have been shifted around. So, with the ability to manage capacity and with congestion as an ongoing problem, that's something that's going to keep more pressure on ocean logistics and probably keep pressure on rates as well.
Got it. I read an article the other day that backlogs within new ships, is actually at like a record high. I don't know if you know anything about that. But in addition, kind of my last area of topic is, what have you seen from companies or anecdotally heard that they're doing to adapt to some of the issues over the last year that potentially sets them up for flexibility in the future, so that a year, 2 years from now, if something happens in the supply chain, that there is a little bit of flexibility around there. What are you hearing anecdotally or even kind of what you heard?
Yeah, so before the pandemic, there was a big shift towards just-in-time inventories. That you want to keep inventories lean and reduce costs on carrying inventories by having goods arrive just in time that you need them. What we saw the pandemic was a big shift to just-in-case inventories. That would be the biggest change in what we talked about for kind of the pull forward of this year's peak season. Is importers being comfortable ordering things much earlier, as you said, just kind of ensure that they have them. And one of that shift is despite how extremely elevated rates have been, we've still seen volumes move, right? We've seen record volumes move, and so we've seen a willingness to pay more for ocean logistics, which for a lot of the last however many years has been really comparatively inexpensive. At times, I know someone who's lighting imports lighting, and at certain points they would just use ocean freight as kind of warehousing. They just keep containers moving from one port to another because it was less expensive than warehouse space. And I think that's kind of been the shift, that's no longer the case, at least for right now. But it's very possible that there's been shown a tolerance for freight rates that won't have some ocean carriers operating at a loss, which also wasn't uncommon. The other thing we've seen, as you said, is kind of shift to technology where possible to make things go, speed things up, have them be more efficient. Things that could take a long time, like getting a freight quote, it could take 2 to 3 days just to get a quote from your freight forwarder. These things moving online is something that I think a lot of stakeholders in the industry have done for the first time during the pandemic, and this isn't something that's going to go away. And so there's better efficiencies that way, and there's also push into more visibility, also in pricing, right? We know anecdotally there's been a tremendous amount of interest, obviously now, in things like the FBX, but that had been an issue previously. There's a lot of prices were opaque. And so visibility to prices is another thing that I think has changed. So I definitely think there'll be kind of lessons learned from the pandemic, maybe a willingness to explore different options that maybe we hadn't seen before.
Cool. I'll give you a moment to just share more about where people can find more information about Freightos, where they can find kind of maybe some of your research pieces. I subscribe to it, so and track all your work for the most part. So anyways, if giving you a second there to share some of the areas to find you.
Sure. So you can learn more about the Freightos group at Freightos.com. As I said, this is a Freightos.com marketplace, as well as web cargo that's connecting carriers and freight forwarders. In addition to that, we have the Freightos Baltic Index, which is at fbx.freightos.com. You can sign up for a free subscription that will get you access to rate data across these 12 major trade lanes. And it will also sign you up for my weekly freight update, which is good because you enjoy it. And you can also sign up just for the update as well at fbx.com, fbx.freightos.com, even without creating an account.
Cool. Great, Judah. Let's end there. I appreciate you coming on. We'll get an update from you in the future. But with that, I guess, good luck. And yeah, we'll be in touch.
Terrific. Thanks for having me.